Ever get that sinking feeling when an unexpected letter arrives in the mail? Especially if it's, got the IRS return address.
Oh, yeah.
Well, you are definitely not alone. It's a moment that can make anyone's stomach just drop.
Absolutely.
Today, we're taking a deep dive into something that touches nearly all of us federal tax procedures. We're talking audits, penalties, even what happens if things get really complicated.
Indeed. And while our tax system is famously based on self-assessment, you figure out what you owe, there are so many layers of oversight. And crucially, taxpayer rights and options that, honestly, people often don't even know exist.
Yeah, exactly. So our mission today is to sort of pull back the curtain on this often intimidating world. We've waded through a ton of essential info, and we're going to boil it down, give you the key takeaways.
A shortcut.
Exactly, a shortcut to understanding what happens when the IRS comes knocking, what your rights actually are, and how to navigate the whole legal landscape if it comes to that. We'll break it all down into clear, understandable chunks. Okay, let's unpack this. So the federal income tax system is described as self-assessment. You figure out what you owe, you report it, and you pay it.
Mm-hmm.
That sounds almost too simple, doesn't it? Like, if everyone just declared what they thought was fair, what's the IRS's role? How do they ensure this voluntary system actually works?
That's the core question, right?
Hmm.
While it is called self-assessment, the audit process is really the backbone that keeps the whole thing functioning.
The oversight mechanism.
Precisely. The Internal Revenue Code says, basically, if you have taxable income over certain amounts, you have to file a return and pay your taxes on time. So an audit is the IRS's main tool for checking up on that.
Just verifying things.
Exactly. It's a methodical review of a return to verify its accuracy. It can get triggered for lots of reasons, happen in different ways. But the goal for the IRS is always checking your self-assessment.
And what happens after they check?
Well, after the audit, if they propose changes, maybe you owe more tax, sometimes you might even get a refund. You'll have options. You can agree, pay up if needed, or if you disagree, you have a fundamental right to appeal their decision. That's really important.
Okay.
And just a heads up, if they find you underpaid, interest on that unpaid amount is almost always due, usually calculated way back from the original tax return deadline.
Ouch. So interest on top of the tax.
Yep.
It sounds a bit like being called into the principal's office, but for your money. But how does the IRS even pick which returns to look at? Is it just rotten luck, or is there some method? It feels so random sometimes.
Yeah, it can definitely feel that way, but it's far from random. It's actually a very sophisticated multi-pronged approach, not just bad luck, usually.
Okay, so what's the main method?
First off, and this is probably the biggest one, they use statistical models. Think of it like a super smart computer program giving your tax return a kind of risk score.
The risk score.
Yeah, it's called the Discriminant Inventory Function System, or DIF for short. This algorithm is designed to pinpoint returns that are statistically most likely to have errors, and this is key likely to result in significant extra tax revenue if audited.
Ah, so it's not just any error. It's errors that mean more money for the government.
That's a big part of it. It's about efficiency for them. So that's a real aha moment, right? It's not just about accuracy. It's about potential revenue recovery. Understanding that might change how you think about your record keeping.
So it's definitely not throwing darts at a board. It's strategic. But are there any random picks or other common things that might put you on their radar?
Good question. While those statistical models are the main driver, a small number of returns are actually selected randomly, manually.
Just to keep everyone on their toes.
Kinda, yeah. It ensures the system isn't only based on algorithms and reminds taxpayers that theoretically any return could get looked at.
Okay, what else?
Another big trigger is a prior year audit. If you got audited before and that audit found you owed a substantial amount more tax, well, that increases the odds that your returns in subsequent years might get audited too.
So past issues can linger.
They can. It shows a sort of continuity in IRS scrutiny if you've had significant problems before, like a follow-up checkup.
Makes sense.
Then there's something incredibly common: information return discrepancies. The IRS gets copies of things like your W-2s, your 1099s from banks or clients.
Right.
They cross-reference those like crazy. If the income or, say, deductions you reported don't match up with the info they got from those third parties, that's a huge red flag.
So matching is critical.
Absolute critical. Or if they get info from other sources, maybe a whistleblower, or something pops up during someone else's audit that can trigger one for you too, it just hammers home how important accurate reporting is, making sure everything aligns. That W-2 needs to match what's on your 1040.
Got it. Anything else?
Yeah, one more common one. If your deductions seem way out of line with established norms,
Yeah.
say your itemized deductions are significantly higher than what's typical for someone at your income level.
Like claiming massive home office expenses when you barely work from home.
Exactly. Or maybe huge charitable donations that don't quite fit your income picture. Those kinds of deviations from the average, or even from your own prior years, can definitely flag a return. The IRS uses data analytics to spot these outliers.
Okay, so it's definitely not random guesswork. Once your return is flagged, how long do they have? Is there a time limit for them to actually start the audit?
Yes, there is. They don't have forever. It's governed by something called the statute of limitations.
Right.
For most individual returns, the IRS tries to conduct audits within 2 years of when you file the return.
Okay, 2 years is typical.
But legally, they can audit any time before that statute of limitations runs out. The standard limit for assessing extra tax is generally 3 years from the later of the return's due date, or the date you actually filed it.
3 years normally? Are there exceptions?
Oh, yes. For example, if you substantially understated your income, like you left off a big chunk, that statute can extend to 6 years. And in cases of fraud, there's generally no time limit at all.
Wow, no limit for fraud.
And here's something interesting about taxpayer power, or agency. You can actually agree to extend the statute of limitations if the IRS asks.
Why would you do that?
Well, sometimes they need more time for a complex audit, or maybe they're nearing the deadline and it allows for more negotiation time instead of them just issuing a notice. It's a strategic choice sometimes. And just to note, large corporations play by different rules. They're often under annual audit. It's just a different level of continuous scrutiny.
So, okay, you've been selected. Does that automatically mean agents are going to show up, go through everything with a fine-tooth comb, or are there different, maybe less intense levels of examination?
Absolutely, there's a spectrum. Knowing the difference can really help manage your stress levels.
Okay, what's the least intense?
That would be a correspondence audit. This often starts because of simple math errors or those information mismatches we talked about.
Like your W-2 didn't match your return.
Exactly. Or maybe an incorrect social security number, a missing signature, simple calculation mistakes, things that can often be fixed through the mail.
So no meeting required.
Right. Typically, you'll just get a letter with a revised calculation, an explanation of the change, and either a bill for the difference or maybe even a refund check.
That sounds manageable.
It often is. The key point is no formal meeting. And if you pay any amount due promptly after getting that notice, usually there's no extra interest charged for that specific adjustment period. But if you don't pay on time, interest will start ticking from the notice date. So yeah, definitely the least bad type of audit experience.
Okay, correspondence is one level. What if it's more involved than just a letter?
Right. If they need more, it escalates to a formal examination, which usually takes one of two forms: an office audit or a field audit.
Office audit. Does that mean you have to go to their office?
It can, yes. An office audit is conducted by an IRS revenue agent. It might happen at an IRS office, or sometimes it can still be handled through correspondence, just more involved than the initial type. These are usually for individual returns with few or no business income items.
And what are they looking for?
Typically, they ask you to substantiate specific things, like provide receipts for a large charitable donation you claimed, or proof of medical expenses, or documentation for certain credits. It's usually focused on just a few specific issues on your return.
So more targeted. What about the field audit? That one sounds more serious, like they come to you.
It generally is the most comprehensive, yes. A field audit is conducted by an IRS representative, and they might come to your office, your home, or maybe the place of business of your representative, like your accountant's office.
They decide where.
The IRS determines the time, place, and manner of the examination. And here's a really technical detail for you. During a field audit and interview, you, the taxpayer, have the right to make an audio recording of the entire interview.
You can record them.
Yes, this is a powerful right. It gives you a clear, undeniable record of everything said, questions asked, answers given. It ensures transparency and can be incredibly valuable if disputes pop up later about what was discussed.
That's huge. Should you always do it? Does it make things more hostile?
That's a great strategic question. It's a safeguard, but not always necessary. Some tax pros prefer not to, feeling it can make the atmosphere more adversarial.
Right.
But if the case is complex, there's a lot of money involved, or maybe you have concerns about the agent's approach, recording can be very smart. You usually need to tell the agent beforehand, typically in writing, that you plan to record. And they have the right to record too if you do. It's about accountability.
So you've gone through the audit. Maybe it was just a letter, maybe a meeting, maybe they visited your office. You've handed over documents, answered questions. What's the next step? Is it finally over, or are there more potential twists?
Hopefully it's the end of the road, but yeah, there are different ways it can conclude, and some definitely lead to more steps. Let's walk through the after the audit phase. The first, and often best case scenario, is that the issue is resolved by agreement. The revenue agent finishes their review and either accepts your return as you filed it, or they recommend some changes.
And if you agree.
If you agree with those changes, you'll sign a form, Form 870. That's the waiver of restrictions on assessment and collection of deficiency in tax.
What does signing that do?
Good question. Once you file Form 870, interest on any extra tax you owe stops piling up 30 days later. Then you'll get a bill for the tax and interest, or maybe a refund check if they found you overpaid.
But what rights do you give up?
This is critical. By signing Form 870, you waive some significant rights. You give up the right to get certain formal legal notices from the IRS, and you waive your right to take the case to the U.S. tax court. You also skip the internal IRS appeal process.
So it closes the case.
Usually, yes. It generally closes that particular audit. But, and here's a surprising little caveat, the IRS can technically still assess additional deficiencies later if needed, even after you sign Form 870. It's not super common, but it means it's not absolutely final in all circumstances.
Okay, so agreement is one path. What if you just don't agree with the agent's findings?
That's the second scenario.
Yeah.
Unresolved issues. If you and the revenue agent just can't reach an agreement, maybe you strongly believe your position was correct or you disagree on the facts, then you don't sign the Form 870.
Then what happens?
In that case, you'll receive a copy of the revenue agent's report, the RAR, which details their proposed changes and reasoning. Along with that, you'll get what's called a 30-day letter.
The 30-day letter, what's that?
It's a preliminary notice. It formally tells you about your right to appeal the findings within the IRS's own administrative process. You then have 30 days from the date on that letter to formally request an appeal with an appeals officer. This is often called an appeals conference. It's your next shot at resolving it internally.
So you don't immediately get thrown into court, which is good news.
Exactly. There's an internal path first.
No, you mentioned a third option earlier, fast-track remediation. That
Wow.
sounded interesting. Who's that for, and how does it actually work? Is it like skipping the line?
Yeah, fast-track remediation is a less common but potentially very useful option. It's specifically aimed at small business owners and self-employed individuals.
Okay.
The goal is to resolve tax disputes really efficiently, usually aiming for a resolution within about 60 days.
60 days.
What's unique is how it works. A specially trained mediator from the IRS Office of Appeals gets involved. Their job is to help both you, the taxpayer, and the IRS revenue agent find some common ground on the disputed issues.
So a neutral party from appeals steps in early.
Exactly. They're impartial and facilitate a discussion focused on settlement. Imagine, say, a small business owner arguing over home office deductions. Fast Track could bring them and the agent together with this mediator to look at the documents quickly and maybe find an acceptable compromise, avoiding a long, drawn-out fight.
That sounds great. Are there catches? Can anyone use it?
There are limitations. It's not available for every single type of issue. For instance, if the issue involves something where there's no clear legal precedent, or maybe courts in different parts of the country disagree on the law or certain other specialized situations, Fast Track isn't an option.
But if it doesn't work,
Good point. If you go through Fast Track mediation and still can't reach an agreement, the good news is you haven't lost anything. The standard appeals process is still fully available to you. So it's a worthwhile early option for many small businesses to try and resolve things quickly.
okay, so if you don't agree with the audit, you get that 30-day letter and you decide to appeal. This administrative appeals process sounds like a really crucial step designed to keep things out of court if possible. What actually happens at an appeals conference?
You've hit on a really vital point. The appeals conference is your next major stop if you haven't settled with the revenue agent. It gets triggered by that 30-day letter, giving you 30 days to request it.
And who handles it? Is it just another auditor?
No, and this is key. It's handled by the IRS Office of Appeals. And their primary mission, which surprises many people, is actually to resolve tax controversies without going to court.
Really? They want to settle?
Yes, that's their goal. They act as an impartial body within the IRS, separate from the auditors who did the initial examination. The appeals officer have authority that the revenue agent doesn't. Specifically, they can consider the hazards of litigation,
Hazards of litigation, meaning,
meaning they look at the chances, the risks of the IRS winning or losing if this case actually went to trial. Based on that risk assessment, they can propose settlements that might be more flexible or maybe concede certain points that the original auditor couldn't.
that's fascinating. So it's less about just re-auditing and more about finding a practical resolution, considering the risks of court.
Exactly. They review the case, weigh the strengths and weaknesses of both sides' arguments, and try to find a resolution acceptable to both parties.
What if you do reach an agreement with appeals? Is there another form?
Yes. If you settle with the appeals division, you sign a different form, Form 870 AD. It's similar to the Form 870 you might sign with the agent, but the Form 870 AD settlement is generally considered more final and binding on both you and the IRS.
More final. How so?
Once the IRS receives and accepts the Form 870 AD, interest stops accruing on the agreed amount. And crucially, it's much harder for either side to reopen the case later on the issues covered by the agreement. It provides more certainty than the standard Form 870.
Okay, but what if even appeals can't bridge the gap? No agreement reached there either.
Right. If, even after going through the appeals conference, you and the IRS still can't agree, then the next crucial document comes your way, the 90-day letter.
The 90-day letter. So if appeals doesn't work out, you get this letter. What exactly does that mean for you? This sounds like the final stop before things potentially escalate to court.
It absolutely is a critical point, maybe the most critical decision point in the whole process. The 90-day letter, which is officially called a notice of deficiency, gets issued in two main scenarios. Either you never requested that appeals conference after the 30-day letter, or you went to appeals but couldn't reach an agreement.
And you have 90 days too.
You have a strict 90-day window from the date the letter is mailed. Within those 90 days, you have to make a fundamental choice. You must either, 1, pay the deficiency the extra tax the IRS says you owe, or 2, file a petition with the U.S. tax court.
Pay or go to tax court? Are those the only options? What about other courts?
This is where it gets really significant, a major aha moment for many taxpayers about how the system works. If you want to fight the IRS in court, but you'd prefer to go to a U.S. District Court or the U.S. Court of Federal Claims rather than the tax court, there's a massive difference in procedure.
What's the difference?
You must first pay the full tax deficiency that the IRS claims you owe. Pay it all up front. Only after you've paid in full can you then file a claim for a refund, and if the IRS denies that claim, then you can sue them for the refund in district court or the Court of Federal Claims.
Whoa, so pay to play for those courts?
Essentially, yes.
Yeah.
This pay first, sue later rule is not just a small detail, it's a huge financial barrier. For many taxpayers, the inability to pay the disputed amount up front means the U.S. tax court isn't just an option. It becomes the only practical path to challenge the IRS in court, purely due to the financial requirement. It completely dictates your litigation strategy.
Wow, that is a massive distinction. If you don't have the cash up front, your choices for which court hears your case shrink dramatically. Okay, so when those administrative routes fail and you're facing that 90-day letter, potentially looking at court, this is where things get really serious. What are the key things we need to understand about taking a tax dispute into the federal court system?
Right, when you can't resolve things administratively with the IRS, either with the agent or through appeals, the dispute moves into the federal court system. Either you or the IRS can initiate this.
And how is that system structured for tax cases?
Think of it like a hierarchy. You have trial courts where the case starts, evidence is presented, witnesses might testify. Then you have appellate courts, which review the decisions made by those trial courts.
Okay, which courts are the trial courts for tax?
The main trial courts where federal tax cases can begin are the U.S. Tax Court, the U.S. District Courts, and the U.S. Court of Federal Claims.
And the appellate courts?
If a decision from one of those trial courts is appealed, it goes up to the appellate courts. These include the various U.S. Courts of Appeals, also called circuit courts, the specialized U.S. Court of Appeals for the Federal Circuit, and ultimately the Supreme Court of the United States.
And what do these appellate courts actually do? Do they rehear the whole case?
No, and that's a vital distinction. Appellate courts are primarily limited to reviewing the record from the trial court. Their job is to determine if the lower court applied the law correctly to the facts found during the trial. They rarely, almost never, disturb the trial court's findings of fact.
So they're focused on legal errors, not rejudging the facts.
Exactly. It's not a do-over of the trial. It's a review of the legal process and reasoning of the lower court.
Okay, before we dive into the specifics of each of those trial courts, because they sound quite different, are there some basic legal concepts that are just fundamental for anyone even thinking about going to court over taxes?
Absolutely. Understanding these foundational ideas is crucial before you even pick a court, because they shape how the entire case will unfold.
Like what?
First, and maybe most important, is the burden of proof. Generally, in any lawsuit, the party bringing the case has the burden of proving their claims.
So who has the burden in tax cases, the IRS or the taxpayer?
Here's a common misconception. In the vast majority of civil tax cases, the taxpayer generally has the burden of proof. You have to prove the IRS's determination is wrong. Many people assume the government has to prove you wrong, but usually it's the other way around.
Really, the burden is on me. Can that ever shift?
Yes, it can, but only in specific circumstances. The burden of proof can shift to the IRS in court proceedings involving income, gift, estate, or generation-skipping taxes if the taxpayer does a few things, introduces credible evidence for their position, has maintained all the required books and records, and has fully cooperated with reasonable requests from the IRS for information.
So good records and cooperation are key to potentially shifting that burden.
Absolutely. Meeting those conditions can significantly help your case in court, but it's often a high bar for the average taxpayer to clear fully.
Okay, burden of proof is huge. What else?
Second key concept, the doctrine of stare decisis. This is a core legal principle, basically meaning to stand by things decided. It means judges are generally required to respect and follow the precedents set by prior court decisions on similar facts. Courts look to past rulings to guide current ones. This provides consistency and predictability. So when you're assessing your tax case, what happened in similar cases before yours carries a lot of weight and heavily influences the likely outcome. That's why legal research is so critical.
Got it. Past cases matter. What's the third concept?
Finally, understanding the potential appeal outcomes. If your case goes from a trial court to an appellate court, what can happen? There are a few main possibilities. The appellate court might affirm the lower court's decision, meaning they agree with it and uphold it.
Okay.
They might reverse the lower court's finding, meaning they overturn the decision,
Mm-hmm.
or they might remand the case. This means they send it back down to the lower court for further consideration, maybe with specific instructions on how to reevaluate certain issues or apply a different legal standard. Knowing these potential outcomes helps clarify what an appeal can realistically achieve.
Okay, that's our legal toolkit. Burden of proof, stare decisis, appeal outcomes. Now, let's get into the nitty-gritty of those trial courts. You said there are three main ones, each with its own rules and quirks. Where can a taxpayer actually go to argue their case?
Right. This is where the strategic choices really matter, depending on your specific situation, your finances, and what kind of trial you want. You've got three doors, essentially.
Door number one.
Door number one is the U.S. Tax Court. This is unique because it's a highly specialized court that only hears federal tax cases, income, estate, gift, certain excise taxes. That's its sole focus.
And what's special about how it operates?
A huge feature is that it generally hears cases before the IRS formally assesses the tax. Remember that 90-day letter. You petition the tax court before you have to pay.
Ah, the no payment required court.
Exactly. That's its single most significant distinguishing feature and a massive advantage for taxpayers who can't afford to pay the disputed amount up front. It's the only court where you can litigate without first paying the disputed tax in full.
Is there an option for smaller cases there?
Yes, within the tax court, there's a small cases division. This is an option if the amount of tax in dispute isn't more than $50,000 for any single tax year.
And how is that different?
It's much more informal, simpler procedures. But here's the trade-off. Neither you nor the IRS can appeal the decision from the small cases division. And the decision doesn't set a precedent for future cases. So it's quicker, less intimidating for smaller amounts, but you give up your appeal rights.
Okay, so tax court. Specialized, no payment first, small case option, no juries, right?
Correct. Trials are before a single judge who is a tax expert. No jury trials in tax court. And taxpayers can represent themselves, although getting legal help is usually wise. You typically have to file your petition within 90 days of that notice of deficiency being mailed. You can't just go there any time. You need that 90-day letter first.
And their decisions.
They issue different types. Regular decisions usually involve new or unusual legal points. Memorandum decisions typically apply existing law to specific facts. And summary opinions are for those small tax cases.
Okay, U.S. tax court sounds like the go-to if paying first is impossible, and you get a judge who knows tax law inside out. What's door number two?
Door number two is the U.S. District Courts. These are the main general trial courts in the federal system. They handle all sorts of federal cases, both civil and criminal. not just tax.
So not specialized in tax.
Right. There's at least one district court in every state, plus territories. Usually you'd file in the district where you live or run your business.
And the big difference from tax court.
The huge difference. You can only take your case to a U.S. district court after you've first paid the disputed tax the IRS claims you owe. Then you file a claim for a refund, and if that's denied, you sue the IRS for your money back. Remember that pay-to-play aspect we discussed. That applies here.
Got it. Pay first. What about the trial itself?
Cases are heard by a single judge who, unlike tax court judges, is likely not a tax specialist because they handle such a wide variety of cases. And this is unique to district courts, in tax cases, the taxpayer can request a jury trial.
A jury trial for a tax case.
Yes. It's the only one of the 3 trial courts where you can have a jury decide the facts of your case. That can be appealing to some taxpayers. You generally need to file your refund claim within 3 years of filing the return or 2 years of paying the tax, whichever is later.
Okay, district court. Pay first, general judge, but you can get a jury. What's behind door number 3?
Door number 3 is the U.S. Court of Federal Claims. This is a nationwide court physically located in Washington, D.C., but it hears cases from all over.
What kinds of cases?
It handles most claims for money damages against the United States government. Tax refunds fit into that category. It actually shares jurisdiction with the district courts for smaller refund claims, under $10,000.
Yeah.
The statute of limitations here is generally 6 years from when the claim first arose.
Yeah, and the payment rule?
Same as district court.
Yeah.
You must pay the disputed tax first, then file a refund claim, and then sue for the refund if it's denied. Pay to play again.
Jury trial option here.
No. There are no jury trials in the U.S. Court of Federal Claims. Cases are decided by one of its 16 judges. This court tends to handle larger, more complex claims, often involving high-net-worth individuals or major corporations, partly because of its nationwide reach and focus on monetary claims against the U.S.
Okay, so 3 trial courts, each with major differences, especially that huge pay-first hurdle for 2 of them. It really does make the tax court the only practical path for many. Now, once a decision is made at the trial level, tax court, district court, or court of federal claims, what happens if you still disagree? Where do you go next to keep fighting?
That's right. The trial court decision isn't necessarily the end of the line. If you disagree with the outcome, you generally have the right to appeal to a higher court.
Which courts hear those appeals?
It depends on where your trial was. The first level of federal appellate courts are the U.S. Courts of Appeals, often called the circuit courts. There are 13 of these across the country. They hear appeals from decisions made by the U.S. district courts and the U.S. tax court.
So appeals from district and tax court go to the circuit courts.
Correct. Your specific case goes to the circuit court that covers the geographic region where the trial court was located.
What about appeals from the Court of Federal Claims?
Those go to a different place. There's a specialized appellate court called the U.S. Court of Appeals for the Federal Circuit. Its job is specifically to hear appeals from the U.S. Court of Federal Claims, among other specialized courts.
Okay, so circuit courts for district tax court appeals, Federal Circuit for Court of Federal Claims appeals. Is that the top, or can you go higher?
You can potentially go higher to the very top. The U.S. Supreme Court. It's the highest court in the nation, the final level of appeal.
Does the Supreme Court hear a lot of tax cases?
Actually, no. It consists of 9 justices, no jury, and they only hear cases they specifically agree to take on, which is called granting a writ of certiorari. It's a surprising fact for many, but the Supreme Court seldom hears tax cases.
Really? Why not?
They usually only take a tax case if there's a major disagreement among the lower courts of appeals, like if the Second Circuit ruled one way on a tax issue and the Ninth Circuit ruled the opposite way on the same issue. The Supreme Court might step in then to resolve that conflict and provide a single nationwide answer. But getting your individual tax case heard by the Supreme Court, exceptionally rare, usually reserved for truly significant unresolved legal questions.
Okay, wow. We've mapped out the entire journey from audit notice all the way potentially to the Supreme Court. That's the process if you disagree. But what about the consequences if you just don't follow the rules? What kind of penalties are taxpayers facing if they fall short on compliance?
That's absolutely crucial to understand. The Internal Revenue Code is filled with sections outlining various penalties the IRS can impose. These exist for both civil mistakes and, in serious cases, criminal actions.
And why so many penalties?
They serve a few purposes, really. They're meant to encourage people to comply voluntarily, to ensure the system is fair for everyone who does comply, and frankly, to act as a deterrent against errors or intentional cheating.
Let's dive into some specific penalties then, because this is where it gets really tangible for listeners. What are some common ones people should absolutely know about?
All right, let's unpack some key ones. One that's a bit different, more of a restriction than a fine, relates to the Earned Income Credit, or EIC.
Okay.
If you negligently claim the EIC, meaning you made a mistake due to carelessness, you might be barred from claiming that credit for the next 2 years. If the claim was found to be fraudulent, that ban can stretch up to 10 years. So not a dollar penalty, but losing a valuable credit is significant.
Definitely. What about payment issues?
Very common is the penalty for failure to make sufficient estimated income tax payments. This hits taxpayers, individuals, corporations, trusts, etc., who don't have enough tax withheld from their paychecks and don't make adequate estimated tax payments throughout the year.
Who needs to make estimated payments?
Generally, self-employed people, freelancers, investors, anyone who doesn't have taxes automatically withheld. This penalty adds up from the date each estimated payment was due until the tax return's due date.
Are there ways to avoid it? Because estimating income can be tricky.
Yes, thankfully. There are several key exceptions really important for you to know. You avoid the penalty if your total tax due for the year is less than $1,000.
Okay, small amounts are safe.
Or if your withholding and timely estimated payments cover at least 90% of your current year's total tax liability.
90% of this year's tax.
Or if you paid at least 100% of your last year's total tax liability. There's a slight modification here. If your adjusted gross income, AGI, last year was over $150,000, you need to have paid 110% of last year's tax.
So using last year's tax as a benchmark is often a safe harbor.
It often is, yes. And finally, there's an annualized income method, which helps if your income fluctuates a lot during the year. If your payments meet the requirement based on that method, you're also safe.
Okay, those exceptions for estimated tax are really helpful. What about just not filing your return on time? Or not filing at all? That seems pretty basic.
It is basic, and the penalties reflect its importance. The failure to file penalty is generally more severe than the penalty for not paying on time.
How much is it?
It's 5% of the tax due for each month, or even part of a month, that your return is late. But it maxes out at 25% of the tax you owe.
5% per month sounds steep.
It is. And there's a minimum penalty if your return is more than 60 days late. For returns due in recent years, that minimum is the lesser of $485 or 100% of the tax due. So even if you owe a small amount, being really late can trigger a significant minimum penalty.
What if you don't owe any tax? Is there still a penalty for filing late?
Good question. No, if you don't actually owe any tax, there's no failure to file penalty. The penalty is based on the unpaid tax.
And what if you fail to file and fail to pay? Do you get hit twice?
Sort of. If both penalties apply in the same month, the failure to file penalty, the 5% one, is reduced by the amount of the failure to pay penalty for that month. So the total penalty isn't 5.5%, it's capped at 5% per month combined in that situation.
Okay. And are there specific penalties for businesses?
Yes, for partnerships and S corporations that fail to file their informational returns on time, there's a specific penalty calculated per partner or shareholder per month, up to 12 months. It was $235 per partner shareholder per month recently, emphasizing the need for these entities to file timely. Related, but distinct, is the failure to pay penalty. This applies when you file on time, but you don't pay the tax you owe by the deadline.
And how much is that one?
This one is lower.
Yeah.
It's 1/2 of 1%, 0.5% of the unpaid tax for each month or part of a month the tax remains unpaid. Like the failure to file penalty, it also maxes out at 25% of your unpaid liability.
0.5% per month. Still adds up over time.
It definitely does. There's an important way to avoid this one, though, even if you get an extension to file. You generally avoid the failure to pay penalty if you pay at least 90% of your total tax liability by the original unexpended due date, usually April 15th, and then you pay the remaining balance by the extended filing date.
So paying most of it by April 15th helps avoid the penalty, even if you file later with an extension.
Exactly. That 90% payment by the original due date is key.
Okay, those penalties cover deadlines and payments. What about mistakes on the return itself? Like you calculated something wrong, maybe you were careless, or maybe you took an aggressive position on a deduction.
Right. That brings us to the accuracy-related penalties. These focus on the substance of what you reported. The first level is the negligence penalty with respect to an understatement of tax. This applies when your understatement isn't considered substantial.
Negligence penalty. What triggers that?
It's an accuracy penalty imposed if your underpayment resulted from negligence or disregard of tax rules and regulations. The penalty is 20% of the portion of the underpayment attributable to that negligence or disregard.
What counts as negligence or disregard?
Negligence generally means failing to make a reasonable attempt to comply with the tax laws. Disregard means being careless, reckless, or intentionally ignoring the rules. It's about not exercising due care.
Okay, 20% for negligence. Can you get hit with multiple accuracy penalties?
No, generally not on the same dollar of underpayment. If the IRS imposes this negligence penalty, they cannot also impose the penalty for a substantial understatement or a substantial valuation misstatement on that same portion of the underpayment. Which brings us to the next level, the penalty for substantial understatement of tax. This is also an accuracy-related penalty.
How is it different from the negligence one?
It's also 20% of the understatement, but it applies when the understatement is considered substantial. The trigger isn't necessarily negligence, but the size of the error.
And what makes an understatement substantial?
For individuals, an understatement is substantial if the amount of the understatement exceeds the greater of 1, 10% of the correct tax liability for the year, or 2, $5,000.
10% or $5,000, whichever is bigger?
Exactly. For C corporations, the thresholds are different and generally higher, reflecting their scale. And again, if this substantial understatement penalty is imposed, the IRS can't stack the regular negligence penalty or the substantial valuation penalty on top of it for the same error. Then there's another specific accuracy penalty, the penalty for a substantial valuation misstatement.
Valuation misstatement, like for property or assets.
Precisely. This often comes up with things like donations of property, business assets, or complex financial instruments where assigning a value is tricky. This penalty is also 20% of the understatement of tax, but only the portion attributable to the valuation error. It applies if that tax understatement due to the bad valuation exceeds $5,000 or $10,000 for corporations.
So getting the value wrong can trigger its own penalty.
If the valuation error is significant enough, yes. There are specific rules for different types of transactions, like those between related parties, Section 482 rules. And for charitable contributions, there are potential defenses, like showing you acted in good faith, got a qualified appraisal, and reasonably investigated the value. Like the others, this penalty can't be imposed in addition to the negligence or substantial understatement penalties on the same part of the underpayment.
So we've got penalties for being late, not paying, being negligent, making substantial errors, and getting valuations wrong. What about the absolute worst case scenario? What if someone deliberately tries to cheat the system? Fraud.
Right. Finally, we reach the most severe category, fraud penalties. These are reserved for situations where the IRS believes the taxpayer acted willfully and deliberately to evade tax, and fraud can lead to both civil and criminal penalties.
Civil and criminal, what's the difference?
The civil fraud penalty is hefty. It's at least 75% of the portion of the tax understatement that is due to fraud. So if you fraudulently underpaid $10,000 in tax, the civil penalty alone could be $7,500 or more.
75%, that's huge. What about criminal penalties?
Criminal fraud penalties are even more serious. They can involve substantial fines up to $100,000 for individuals, $500,000 for corporations per offense, and significantly, potential imprisonment.
Jail time for tax fraud.
Yes, but the bar for proving fraud is extremely high for the IRS. For the civil penalty, they must prove by clear and convincing evidence that the taxpayer willfully and deliberately attempted to evade tax. For a criminal conviction, the burden is even higher. The government must prove that willful attempt to evade tax beyond a reasonable doubt. That's the highest standard of proof in our legal system.
So proving intent is absolutely critical for fraud.
Absolutely. It signifies the extreme seriousness. It's not just about making a mistake, it's about intentional deception.
Okay, so if you unfortunately get hit with one of these penalties, failure to file, accuracy related, whatever, does interest start piling up on the penalty amount itself? Or is interest only charged on the original tax you owed? It feels like it could really snowball.
That's an excellent question, and yes, it absolutely can snowball. For many penalties, including the failure to file and accuracy-related penalties, interest does begin to accrue on the penalty amount itself.
When does that interest start?
It generally starts from the due date of the tax return, including extensions if you filed one. So you could owe the original tax, interest on that tax starting from the original due date, and a penalty, and interest on that penalty starting from the return due date or extended due date.
Wow, interest on the tax and interest on the penalty.
Exactly. This is different from the interest on the underpaid tax itself, which generally starts accruing from the original tax due date, like April 15th, without regard to extensions for filing. But yes, penalties can accrue their own interest, significantly compounding the total amount owed over time.
This all sounds pretty daunting, and those penalties can clearly add up fast. But presumably, there are ways to protect yourself, right? What steps can taxpayers take when they're figuring out their taxes to try and avoid getting hit with these penalties in the first place?
Absolutely, yes. Understanding how to potentially avoid penalties is just as important as understanding the penalties themselves. It's not just about being accurate, it's also about the legal foundation for the positions you take on your return.
So what's the first thing to avoid?
First, let's talk about what not to do. Filing a frivolous tax return. Frivolous positions are arguments that have absolutely no basis in law or fact. Think of those tax protester arguments that courts have rejected time and time again.
Like saying wages aren't income.
Exactly that kind of thing. Here's the crucial point. Simply disclosing a frivolous position on your return will not protect you from penalties. You can't just say, hey, IRS, I'm taking this baseless position and expect to avoid penalties. The IRS sees that as gaming the system. Okay, so beyond avoiding frivolous positions, how do you build a defense against penalties for positions that are maybe uncertain but not baseless?
Right. What about gray areas?
This is where different standards of confidence come into play, indicating how strong your legal basis is. The lowest level that offers some protection is the reasonable basis standard.
Reasonable basis. What does that mean?
A position has a reasonable basis if it has at least a 20% chance of succeeding if challenged in court. It means the position is arguable, it's based on some authority, even if it's fairly unlikely to ultimately win.
So better than frivolous, but still a long shot, maybe.
Kind of, but importantly, this standard isn't met if you just took a position that seemed too good to be true without making a reasonable effort to check if it was actually correct.
What protection does reasonable basis give you?
This is key. Meeting the reasonable basis standard generally avoids the negligence penalty, the 20% penalty for non-substantial understatements, and the penalty for disregard of rules, even if you don't specifically disclose the position on your return.
Okay, so it protects against negligence without disclosure. What about the substantial understatement penalty?
For that penalty, reasonable basis alone usually isn't enough unless you also disclose the position on your return using the proper forms, which we'll get to. There's an exception for tax shelters, where disclosure plus reasonable basis typically isn't sufficient.
So even if it's only got a 20% chance, having a reasonable basis plus disclosure can protect against the substantial understatement penalty. What's the next step up in confidence?
A significantly higher standard is the substantial authority standard. This means your tax position has more than a 40% chance of succeeding in court. This indicates a much stronger legal footing than just reasonable basis.
More than 40%. And you mentioned before that what counts as authority here is very specific.
Exactly. We're going to dive into the specific list of what constitutes substantial authority in just a moment because it's crucial and often surprises people. But the key takeaway for now is that only certain official sources count things like the tax code itself, IRS regulations, court cases. Notably, things like articles by tax experts or legal opinions, while helpful, do not count as substantial authority for this purpose.
Okay, that's a critical distinction. Is there an even higher standard?
Yes. The most stringent standard is the more likely than not standard. This means you have a greater than 50% likelihood that your tax position would be upheld by the courts if challenged.
Over 50% chance of winning.
Right. This highest standard is often required for certain complex or potentially aggressive transactions, particularly tax shelters, to avoid penalties. It demands the highest level of confidence in your position's legal validity.
You mentioned disclosure multiple times. Are there specific forms you're supposed to use to tell the IRS, hey, I'm taking this position and here's why? And how do those forms actually help shield you? It sounds like being upfront can be a defense.
Yes, absolutely. Transparency through proper disclosure is a key strategy for penalty protection, particularly against the substantial understatement penalty. There are specific forms designed for this.
What are they?
The main one is Form 8275, Disclosure Statement. You use this form to disclose positions you take on your return that might be contrary to official IRS guidance like revenue rulings or revenue procedures or other statutory provisions, but not contrary to Treasury regulations. There's a different form for that.
And what do you put on it?
It asks for general information, then requires a detailed explanation of the position you're taking, the facts involved, and the legal basis supporting your position. You're essentially laying out your argument for the IRS up front. You also have to provide info if it relates to a pass-through entity like a partnership. Relatedly, there's Form A275R Regulation Disclosure Statement. This one is almost identical to Form A275, but you use it specifically when the position you're taking is contrary to an actual Treasury regulation. Regulations carry more weight than rulings, so there's a distinct form for disclosing positions against them. The goal is the same: transparency to potentially avoid penalties. And then there's a different category of disclosure covered by Form 8886, Reportable Transaction Disclosure Statement. This isn't just about uncertain positions, but about specific types of transactions the IRS wants to track closely.
Reportable transactions, what are those?
It's required if you participate in certain transactions the IRS has flagged for potential tax avoidance. This includes listed transactions, specifically identified abusive schemes, confidential transactions, transactions offering contractual protection against losing tax benefits, and certain large loss transactions. If you're involved in one of these, you generally must file Form 8886 to disclose your participation, regardless of what other parties involved might be doing. Failure to disclose these can carry its own significant penalties.
Okay, so specific forms for specific disclosures. Beyond aiming for those standards like reasonable basis or substantial authority and using disclosure forms, are there any general overarching principles that can help a taxpayer avoid penalties? Kind of like a universal defense strategy?
Yes, there is a general framework that applies broadly across most penalties. Even if a mistake was made, you can often avoid a penalty if you can successfully demonstrate a few key things about your actions and intent.
What are they?
Generally, you can avoid penalties if you show that. 1, you had reasonable cause for the tax position you took or the error that occurred. 2, you acted in good faith. And 3, the error was not due to willful neglect.
Reasonable cause, good faith, and no willful neglect.
Exactly. This 3-part standard is a powerful defense. It essentially argues that you made a genuine, honest effort to comply with the tax laws based on the facts and circumstances, even if the outcome turned out to be incorrect. It focuses on your intent and the reasonableness of your actions, not just the result. Proving this can be a strong shield against many penalties.
That's a really helpful framework. Reasonable cause, good faith, no willful neglect. Now, we keep mentioning that substantial authority standard, the one with more than a 40% chance of success. You said what counts as authority here is specific and sometimes surprising. Can you break that down for us? What specifically does the IRS and do the courts recognize as legitimate authority for this purpose?
This is incredibly important because relying on something that isn't considered official authority won't help you meet that substantial authority standard, no matter how convincing it seems. So here's the definitive list of what does count. First, obviously the Internal Revenue Code itself and any other relevant statutory provisions passed by Congress. That's the foundation.
Makes sense. The law itself.
Second, proposed, temporary, and final Treasury regulations issued by the IRS and Treasury Department that interpret those statutes. These are the official rules.
Okay, regs count.
Third, official IRS pronouncements like revenue rulings, which apply the law to specific facts, and revenue procedures, which explain internal IRS practices and procedures. Also, tax treaties and their related regulations and official explanations from the Treasury Department.
Rulings, procedures, treaties. Got it.
Fourth, court cases. Decisions from the U.S. Supreme Court, U.S. Courts of Appeals, U.S. District Courts, U.S. Court of Federal Claims, and the U.S. Tax Court. Both regular and memorandum decisions all constitute authority.
Prior court decisions are key.
Fifth, expressions of congressional intent. This includes things like official committee reports from the House and Senate tax writing committees, joint explanatory statements from conference committees, and floor statements made by bill managers before a law is enacted. These help understand why a law was written the way it was.
So the history behind the law matters.
Sixth, the general explanations of tax legislation prepared by the Nonpartisan Joint Committee on Taxation. These are often called the Blue Book and provide detailed post-enactment explanations. They are highly regarded.
The Blue Book. Okay.
Seventh, certain IRS administrative rulings issued directly to taxpayers or internally, specifically private letter rulings, PLRs, and technical advice memoranda, TAMs, issued after October 31st, 1976. While a PLR issued to someone else isn't directly binding on you, it shows the IRS's thinking.
PLRs and TAMs under certain conditions.
Eighth, other internal IRS documents like Actions on Decisions, AODs, and General Counsel Memoranda, GCMs, issued after March 12, 1981, and some older GCMs published before 1955. These show the IRS's legal reasoning or stance on court decisions.
Internal IRS legal memos.
And finally, ninth, Other official IRS information are press releases, notices, and announcements that are formally published in the Internal Revenue Bulletin, IRB. These are public guidance statements from the service.
That is an incredibly detailed list. Statutes, regs, rulings, cases, legislative history, blue books, PLRs, TAMs, AODs, GCMs, notices, announcements. It seems quite comprehensive. But you emphasize there's a crucial caveat. What kinds of things do people think are authority but actually aren't on this official list?
This is the crucial caveat that trips people up, the real aha moment here. Conclusions reached in treatises, legal periodicals, legal opinions rendered by tax professionals, or opinions from other experts are not considered authority for the purpose of meeting the substantial authority standard.
Wait, so that detailed analysis from a leading tax law journal or a formal opinion letter from my highly qualified tax attorney, those don't count as substantial authority.
Correct. While those sources are incredibly valuable for understanding the law, for doing your research, for developing your arguments, and for guiding your decisions, they are not official pronouncements by a governmental body, Congress, Treasury, IRS, or a court. They represent analysis or opinion, not binding legal authority in the eyes of the IRS when determining if you had substantial authority for your position.
That is a massive distinction. You can use them for guidance, but you can't rely on them as the authority itself if challenged.
Exactly. It's a key point to remember when evaluating how strong your tax position really is under the formal standards.
Okay, that's incredibly helpful in defining authority. Finally, let's shift gears to something specific that might catch many listeners by surprise because it seems specialized, but it actually has broad application and very serious consequences. Reporting foreign bank accounts. This isn't just for the super rich or international spies, right? What are the rules here, and why should the average person pay attention?
You're absolutely right. This is a critical area that affects far more people than commonly thought. And the penalties for getting it wrong can be draconian. The requirement comes from the Bank Secrecy Act, BSA, not directly from the Income Tax Code initially.
Bank Secrecy Act. Sounds serious.
It requires U.S. persons to report certain foreign financial accounts by filing a specific report called the Report of Foreign Bank and Financial Accounts, universally known as the FBAR.
FBAR. Okay. Why does the government want this info?
The FBAR isn't actually filed with the IRS initially. It's filed with FinCEN, the Financial Crimes Enforcement Network, which is part of the Treasury Department. FinCEN uses FBAR data primarily to help identify money that might be involved in illegal activities, think money laundering, terrorist financing, and also to uncover income generated abroad that hasn't been reported for tax purposes.
Yeah.
So it serves both law enforcement and tax compliance goals. It's a major tool, and they take compliance very seriously.
Okay, combating financial crime and catching unreported income makes sense. But who exactly has to file this FBAR? What's the trigger? Is it only if you have millions overseas?
Not at all. This is where it gets surprisingly broad. Who must file an FBAR? A U.S. person has to file if two conditions are met. First, they have a financial interest in, or signature, or other authority over any financial account that is maintained with a financial institution located outside the United States.
Okay, interest or authority over a foreign account. What's the second condition?
Second, the aggregate value of all such foreign financial accounts exceeds $10,000 at any time during the calendar year.
Wait, only $10,000 and that's aggregate?
Yes, $10,000 aggregate. That threshold is much lower than many people assume, and that's the big aha moment here. Aggregate means you add up the highest values of all your foreign accounts during the year. Even if you have 5 small accounts that never individually hit $10,000, if their combined highest value during the year top $10,000 for even one day, the filing requirement is triggered for all of them.
So a student studying abroad with a couple of local bank accounts, or someone who inherited a modest account or worked overseas for a bit, they could easily hit that $10K aggregate threshold.
Easily.
Yeah.
It catches a lot of people who don't think of themselves as having significant foreign assets. Let's quickly define U.S. person for FBAR. It includes U.S. citizens, U.S. residents like green card holders or those meeting the substantial presence test, and also entities created or organized in the U.S., corporations, partnerships, LLCs, trusts, estates.
And financial account, is that just bank accounts?
No, it's very broad. It definitely includes regular bank accounts, checking, savings, CDs, but also brokerage accounts, securities accounts, accounts holding options or commodity futures, insurance or annuity policies with a cash value, and shares in mutual funds or similar pooled funds if held at a foreign institution. Basically, most types of accounts where you'd hold financial assets.
Okay. And calculating that maximum aggregate value. You said highest value during the year.
Yes. For each foreign account, you find its highest value during the calendar year in its own currency. Then you convert that maximum value into US dollars using the official Treasury Department exchange rate for the last day of the calendar year, December 31st. You do this for all your foreign accounts, add up those maximum US dollar values, and if that total exceeds $10,000 at any point, you need to file an FBAR reporting all the accounts.
Got it. Find the peak value in foreign currency. Convert using the year-end rate. Add them all up. If the total peak exceeds $10, file. That aggregate rule and low threshold are really eye-opening. So let's say you realize, oops, that's me. I meet the criteria. How and when do you actually file this FBAR? Is it part of your 1040 tax return?
Good question. No, it's completely separate from your income tax return.
Yeah.
The FBAR is filed on FinCEN Form 114. And another crucial point, it must be filed electronically through FinCEN's own online system called the BSA e-filing system. You cannot mail a paper FBAR form anymore.
Electronic only. What's the deadline?
The official due date is April 15th, following the end of the calendar year you're reporting. So for your 2024 foreign accounts, the FBAR would be due April 15th, 2025. Same as the tax return deadline.
Okay, April 15th. What if you need more time? Do you file an extension, like, for taxes?
Here's some good news and a detail many people miss. There is an automatic 6-month extension to file the FBAR. You don't even have to ask for it. So if you don't file by April 15th, the deadline automatically shifts to October 15th.
Wow, automatic extension to October 15th. That's convenient.
It really is. It gives people extra time without any extra paperwork. Now, what about accounts owned by more than one person, like a joint account?
Yeah, how does that work?
Generally, if an account is jointly owned by 2 or more U.S. persons, each U.S. person who has a financial interest in that account must report the entire maximum value of the account on their own separate FBAR.
So if a husband and wife jointly own an account worth $50,000, they each report the $50,000 on their individual FBARs. Seems redundant.
It does seem that way, but that's the general rule to ensure full reporting. However, there is a specific limited exception just for spouses. If they own all their foreign accounts jointly, one spouse can file a single FBAR reporting all the joint accounts, provided the other spouse signs an authorization form.
Yeah.
That avoids the duplication for married couples in that specific situation. It's also important to know there are some key exceptions to the FBAR filing requirements. Certain people or accounts are exempt.
Like who?
For example, if you own an interest in a corporation, and that corporation files an FBAR that includes accounts you might otherwise have to report, you might be exempt. Also, crucially for many people, participants and beneficiaries in IRAs and tax-qualified retirement plans like 401ks generally do not need to file an FBAR just because the plan itself holds foreign assets.
That's a big relief for retirement accounts.
Yes, and beneficiaries of trusts are often exempt too if the trust itself files an FBAR. These exceptions prevent a lot of unnecessary filings for common situations where the accounts are already being reported elsewhere or are part of regulated plans.
And finally, I'm guessing, like with everything else tax-related, you need to keep records for FBARs too.
You guessed right. Record keeping is essential. You must keep records for each account reported on your FBAR for at least 5 years from the FBAR due date.
5 years? What kind of records?
The records need to contain specific information. The name listed on the account, the account number or other designation, the name and address of the foreign financial institution holding the account, the type of account, bank, securities, etc., and importantly, the maximum value of the account during the year that you reported. Having these records readily available is crucial if FinCEN or the IRS ever comes asking questions about your FBAR compliance down the road.
Wow, what a journey. We've really covered a lot of ground today, haven't we? From figuring out how audits even start to navigating appeals, the whole court system maze, understanding that jungle of penalties, and even hitting those crucial FBAR rules for foreign accounts.
It really highlights just how intricate our federal tax system is. There's a lot of complexity there.
Absolutely. Hopefully, after this deep dive, that whole world feels maybe a little less intimidating, a bit more navigable for you.
Yet what's always fascinating to me is seeing how the system constantly tries to balance encouraging voluntary compliance with having pretty robust oversight mechanisms in place. And the fact that there are these various pathways for resolving disputes, from appeals all the way to the courts.
Right.
And the sheer level of detail in the rules, I mean, down to exactly how a return gets selected by DI score, or what precisely counts as substantial authority. It just underscores that being proactive, understanding the rules, and keeping meticulous records, Those are truly your best defenses.
Your best allies, exactly.
Knowing the procedures can really shift the dynamic from feeling overwhelmed to feeling like you have a handle on the process.
So what does this all mean for you listening right now? Maybe it's realizing that being well-informed about tax procedure isn't just something for CPAs and tax lawyers. It's actually a pretty vital piece of being a financially literate person in today's world. Or maybe it's the slightly mind-bending thought that a tiny mismatch on a W-2 could, in theory, start you down a path that leads to understanding the finer points of U.S. tax court jurisdiction.
It connects in surprising ways.
It really does. So the next time you're gathering your tax documents, maybe wrestling with a tricky deduction, just remember, knowing the process that operates behind the scenes, knowing your rights and the potential pitfalls, that knowledge can offer a powerful sense of peace of mind. Or, at the very least, a clearer map if you do find yourself needing to navigate it.
Well said.
We really hope this deep dive has sparked some profound aha moments for you and ultimately helps you feel more empowered about your own financial landscape, ready to face it with a bit more confidence.